Welcome back to ACCA Wiz. A business may spend heavily on software, patents, brands, and new products, but spending money does not automatically create an intangible asset. In this chapter, you will learn the recognition boundary, apply the research and development rules, calculate amortization, and explain the financial statement effect with confidence. Every question begins with 3 linked decisions. First, identify the resource. Is it separable, or does it arise from contractual or legal rights? Second, recognize it only if the entity controls it. Future benefits are probable and costs can be measured reliably. Third, measure it after recognition through amortization, impairment, and only rarely revaluation. If the first 2 decisions fail, there is no asset to amortize. By the end, you will distinguish purchase intangibles from internally generated expenditure, separate identifiable assets from goodwill, and apply the recognition tests. You will classify research and development, including the exact date capitalization begins. You will calculate amortization for finite life assets, explain indefinite life treatment, and deal with later measurement and disposal. Finally, you will use a clear exam workflow and cross-check the carrying amount. A separately purchased patent or license is normally recognized at cost because purchase evidence supports probability and reliable measurement. Internally generated expenditure requires stricter analysis. Research is expensed. Development is capitalized only from the date all 6 criteria are demonstrated. Internally generated brands, customer lists, and goodwill are not recognized. Once an asset exists, assess useful life, amortization, impairment, and disposal. IAS 38 defines an intangible asset as an identifiable non-monetary asset without physical substance. Identifiable has a precise meaning. The asset is either separable, so it can be sold, transferred, licensed, rented, or exchanged, or it arises from contractual or other legal rights. It must also be a controlled resource created by past events from which future economic benefits are expected. Physical form is not the deciding factor. Alio Health is developing K-Flow, a scheduling platform, for the year ended the 31st of December 20x6. Figures are in thousands of pounds. Research from January to March costs 96. Early development from April to June costs 144, but the final recognition criterion is not demonstrated until the 1st of July. Qualifying development from July to September costs 360. The software is available for use on the 1st of October, has a 4-year useful life and no residual value. Launch marketing and staff training cost 24. Classify each phase before calculating. Identify the resource. Decide whether it was purchased or created internally. Exclude research and prohibited internally generated items. For development, test all 6 criteria and identify the exact date they are first demonstrated. Then capitalize only eligible expenditure from that date, and begin amortization only when the asset is available for use. This order prevents capitalizing too early. A separately acquired intangible asset is initially measured at cost. Cost includes purchase price after discounts, non-refundable taxes, and directly attributable expenditure needed to prepare the asset for intended use, such as legal fees to register a purchase patent. Advertising, staff training, startup losses, and general overhead do not become part of the asset merely because they support its launch. A patent, license, or customer contract may be identifiable separately from a business. Goodwill is different. It represents future economic benefits from acquired resources that cannot be individually identified and separately recognized. Purchase goodwill arises in a business combination and is dealt with under IFRS 3. Internally generated goodwill is not recognized because its cost cannot be separated and measured reliably. Acquisition goodwill is calculated later in the consolidation chapters. IAS 38 prohibits recognition of internally generated goodwill, brands, mastheads, publishing titles, customer lists, and similar items. The issue is not that they lack value. The spending cannot be distinguished reliably from the cost of developing the business as a whole. A purchase brand may be recognized if the normal criteria are met, but internally building the same brand through advertising does not create a recognized asset. Research is a search for new knowledge and understanding. Development applies research findings or other knowledge to a plan or design before commercial production or use. Research expenditure is expenses incurred because the entity cannot yet demonstrate an asset that will probably generate benefits. Development may qualify, but only after all 6 recognition criteria are met. Development expenditure is recognized only when all 6 points can be demonstrated. Completion is technically feasible. Management intend to complete the asset. The entity can use or sell it. Future economic benefits are probable, supported by a market or internal usefulness. Adequate technical, financial, and other resources are available. Finally, development expenditure can be measured reliably. Missing one condition means no capitalization yet. For recall, organize the 6 criteria into 4 evidence groups. Feasibility asks whether the project can be completed. Commitment covers intention, ability to use or sell, and adequate resources. Benefits require evidence of a market, internal usefulness, revenue, or cost savings. Measurement requires reliable project records. This grouping is only a memory aid. Your answer should still address every criterion supported by the scenario. Careflow's January to March investigation is research, so 96 is expensed. From April to June, the team is developing the product, but the final recognition criterion is not demonstrated until the 1st of July. The 144 incurred before that date is also expensed and cannot be reinstated. From the 1st of July, all 6 criteria are supported, so 360 of directly attributable development expenditure from July to September is capitalized. The evidence date controls recognition. Careflow's recognized development asset is 360, not total project spend. Research of 96 and early development of 144 produce an expense of 240 because they occurred before recognition. Qualifying development from the 1st of July to the 30th of September creates the 360 asset. Marketing and staff training of 24 are expensed because they do not create or prepare the software itself for use. Before amortization, the statement of financial position includes 360. A finite life intangible is amortized when it is available for use, meaning it is in a location and condition necessary to operate as intended. Careflow becomes available on the 1st of October, so Alio records 3 months of amortization to the 31st of December. The recognition date tells us when costs can enter the asset. The available for-use date tells us when allocation begins. Keep those dates separate. Careflow has a finite 4-year useful life and no residual value. Straight-line annual amortization is 360 divided by 4, which equals 90. The asset is available for 3 months, so the current year charge is 90 times 3 by 12, giving 22.5. Closing carrying amount is 360 less 22.5, or 337.5. 3 months are 1/4 of the annual 90 charge, which confirms the calculation. A finite useful life has a foreseeable limit to benefits, so the asset is amortized over that life and tested for impairment when indicators exist. An indefinite useful life means there is no foreseeable limit based on current evidence. It does not mean forever. No amortization is charged, but the asset is tested for impairment annually and whenever indicators arise. The assessment is reviewed each reporting period. For a finite life asset, residual value is normally 0 unless a third party is committed to buy it or an active market supports a value at the end of its life. The amortization method should reflect the pattern of consumption. If that pattern cannot be determined reliably, use straight line. Useful life, residual value, and method are reviewed at each financial year end, and estimate changes are applied prospectively. After initial recognition, an entity chooses a cost model or, if fair value can be measured by reference to an active market, the revaluation model for a class of intangible assets. Active markets are uncommon because brands and patent are usually unique, and public pricing for homogeneous items is unavailable. Therefore, cost less accumulated amortization and impairment is much more common in practice and exam scenarios. An intangible asset is derecognized on disposal or when no future economic benefits are expected. The gain or loss is net disposal proceeds less carrying amount at the disposal date recognized in profit or loss. Suppose a license costs 180, accumulated amortization is 75 and net proceeds are 112. Carrying amount is 105, so the gain is 7. Compare proceed with carrying amount, not original cost. Research and pre-criteria development reduce profit immediately. Qualifying development creates an intangible asset, followed by amortization when available for use. An impairment loss reduces profit and carrying amount when required. Disposal removes costs and accumulated amortization, and records a gain or loss in profit. Always state both sides of the effect. The explanation can earn marks beyond the calculation. Pause the video and solve this original ACCA whiz practice. Vega system spends 70 on research. It spends 45 on development before all 6 criteria are demonstrated on the 1st of September, then 200 from the 1st of September to completion. The software is available for use on the 1st of November, has a 5-year life and no residual value. It also spends 18 on launch advertising. Figures are in thousands of pounds, and the year end is the 31st of December 20x6. Calculate the expense, capitalized cost, amortization, and closing carrying amount. Then explain the statement effect. Research of 70 is expensed. Development of 45 before the 1st of September is also expensed and cannot be reinstated. Qualifying development of 200 is capitalized. Advertising of 18 is expensed. Total immediate expense is 133. Annual amortization is 200 divided by 5, or 40. 2 months from the 1st of November gives 6.667, rounded consistently. Closing carrying amount is 193.333. The cross-check is 200 less 6.667. Identify whether the resource is separable or based on legal rights. Classify how it arose, purchased, research, development, or prohibited internal item. Fix the exact date all development criteria are met. Build eligible cost only from that date, then amortize from the available for use date. Finally, reconcile recognized cost less accumulated amortization and impairment to the closing carrying amount and state the profit and asset effects. Test your understanding. First, why is research expensed even when management hopes the project will succeed? Second, why can a purchased brand be recognized while an internally generated brand cannot? Third, what is the difference between the criteria met date and the available for use date? If you can answer in plain English, you are less likely to misapply the rules when the wording changes. Do not capitalize all development merely because the project later succeeds. Start only when all 6 criteria are demonstrated. Do not reinstate early expenses. Do not begin amortization at the recognition date unless the asset is already available for use. And do not revalue without evidence of an active market. Also remember that depreciation of equipment used directly in qualifying development can form part of development cost during the qualifying period. This chapter establishes when an intangible exists and how its carrying amount is built. We noted that finite life intangibles are tested when indicators exist, while indefinite life intangibles and assets not yet available for use require annual testing. Detailed mechanics, recoverable amount, value in use, fair value less cost of disposal, cash-generating units, and reversals belong in Chapter 4. First, get carrying amount right, then ask whether it is recoverable. Return to the learning promise. You can now identify an intangible asset, decide whether expenditure qualifies, separate research from development, calculate amortization, and reconcile the closing carrying amount. Carry 4 ideas into every question. First, identify before recognizing. Separability or legal rights establish the resource. Second, expense research and prohibited internal items. Third, capitalize development only from the date all 6 criteria are demonstrated, and never reinstate early expense. Fourth, amortize a finite life asset from the available for use date and cross-check cost less amortization and impairment. Careflow's recognized cost was $360, its 3-month amortization was $22.5, and its closing carrying amount was $337.5. Next, Chapter 4 asks the uncomfortable question, what if that carrying amount cannot be recovered? Complete one-time research and development question, and I'll see you in Chapter 4, Impairment of Assets.